A lot of people use debt to EBITDA as your metric to determine how much debt there is. But in reality, you should be really looking at debt to free cash flow, or pre-tax free cash flow, because you have to understand how long it's going to take them to actually pay down the debt. And if the company has a lot of capex, then EBITDA is not a good measure
Right.
to figuring out if the company's going to pay off their debt.
So now what's to stop a company from, and I guess this is where the special sauce comes in, and maybe you can tell us a little bit more about specifically what you look for in the cash flows. But what's a company if they have a lot of debt? The equity is the junior most tranche, right? And they can easily just kind of wipe out those people and default that, and then kick it over to and restructure and come out again as a public company later on. Obviously, you don't want to do that too much because then eventually people won't buy anything. But especially nowadays, like what's to keep a company from doing that?
Okay, so there are a couple things that work, right, in terms of growing free cash flow. One thing is when a company has a high interest rate, a above market interest rate, and it's a legacy piece of debt or something like that, right? And it seems like the company's stable enough that they should keep the level of EBITDA for the time being, right? So by refinancing a 10% interest rate, where you might pay $50 million in cash interest, and that can decrease to $20 million, you're increasing free cash flow by $30 million. Right? And that's a very easy way to get some growth in the business. That also accelerates the debt pay down going forward. So there are little things like that can you don't want to buy something with a 1% interest rate,
right?
Because you don't get any leverage, you don't get an increase in free cash flow from paying down interest. We use EBITDA minus maintenance capex minus cash interest. Maintenance capex is a tricky number because a lot of companies will give you maintenance capex, but it's in reality they should be including some of the growth capex in the maintenance capex. So
interesting.
But
okay,
yeah.
very, very cool. Yeah. And so then, and obviously this is mostly, if not entirely, publicly available, the various debt covenants and the various, loans and stuff that the companies have.
You can call the IR and they'll walk you through.
Which is another thing that you do that not many people do, especially on the retail side, but it's a free country, it's a free market, and there's nothing to stop people from calling up the IR's department, which are all public.
Emails. You can ask, you can send the IR person an email, ask them to walk you through the debt covenants.
Totally.